It's a very good question. Government is still a substantial contributor to growth here in the US. I think the key effect that this government shutdown is going to have is going to be on the federal payroll. Now, I think it's important to remember that historically there has been a precedent where the furloughed workers do get back pay once the government reopens. So whenever we have a drop in consumer spending because these workers are not getting paid, we have some kind of payback in the subsequent weeks. So for the quarter as a whole, the effect on GDP tends to be muted. It tends to be about 1/10 or 2/10 of a percentage point. But I think it's not to be taken for granted. It requires an act of Congress to approve this back pay. This is one factor that we need to watch out for. The other factor is that we're hearing the government will use this exercise of who is an essential worker and who is not to deliver more federal workforce layoffs and reductions. And if that's the case, I think the economic implications and the effect on growth can be bigger than it's been historically.
All right, let's follow up on that, Blerina. If we're talking about jobs there in the federal government, how about the jobs in the overall U.S. labor market? How concerned are you about some cracks that may or may not be developing?
So the way I would characterize it is that right now we are in an uneasy equilibrium in the labor market. Just to say it up front, I think the unemployment rate will likely stay stable this year, but demand and supply of workers has diminished significantly from last year, and I think that's the key here. We are not creating jobs at the same rate as we did immediately post-pandemic. Companies are not hiring at a very fast pace, but they're not laying off workers either, and I think there is an element here of labor hoarding. But it doesn't take much, I think, and that's what the Fed is worried about, that it doesn't take much for more layoffs to increase the unemployment rate.
Do you have a glass half full view? I mean, you're sitting there. Can you imagine going into a meeting with Sebastian Page?
T-Rowe.
She must take people into Defender. Blerina, when you go into the portfolio managers at Rowe Price, do you have a glass half full view into 2026?
I think 2026 and potentially even the fourth quarter of this year will be better for activity here in the US. I do think we dealt with a big uncertainty shock, the tariff shock here. The currency has depreciated a lot, so exporters into the world are more expensive. All those shocks are working their way into the system, but I think for 2026 we'll get some tailwind for fiscal as well that should boost growth. I think I am more optimistic about the U.S. labor market than most. I do think that what we're seeing right now is very structural. We are going to get a slower run rate of employment growth, but we're not seeing broad-based weakness that would derail the business cycle and the recovery here.
So given that background, Blerina, how do you think this U.S. Federal Reserve is going to react to rate cuts going forward?
I think they've got a lot to deal with, a lot of uncertainty, and now they might not even get the CPI and the payroll data on time because of the government shutdown. So it's going to be a pretty difficult quarter for the Fed to navigate. They are, of course, worried about the deterioration and slowdown in employment growth. That's why they started cutting in September and indicated they'll cut twice more this year. But if my forecast is right, we're going to get much more of an impulse to inflation from tariffs in Q4. I think it's going to start showing up in consumer prices more. So at that point, you'll have core inflation accelerating even more than it has so far. And let's remember, when you look at core CPI, PCE, you choose your measure. You compare where we are now, it's exactly where we were 1 year ago, 3% inflation. That's a full percentage point higher than the Fed's target. So I think they'll deliver the cuts that they have promised this year. But I think for next year, there is a big question mark. If the economy is doing well and inflation is high, I don't know why the Fed needs to go below where interest rates are going to be.